Global markets are bracing this week for the July 9 deadline for Donald Trump's tariff deals to be done. The Reserve Bank of Australia is expected to cut 25 basis points tomorrow, but the Reserve Bank of New Zealand is expected to hold on Wednesday. And Vietnam has done a two-tiered trade deal with the United States that is not expected to hurt exports too much. That's coming up in our 5 Things in 5 Minutes on Monday, July the 7th. And then in our deep dive interview, ANZ Economist Bansi Madhavani looks more closely at what sort of deals could be done this week and what they might mean.
If we do see reciprocal tariffs coming into effect the way they were announced on 2nd of April, or if the reciprocal tariffs get expanded, these would underscore downside risks to US's growth.
But first, in 5 and 5 with ANZ, US President Donald Trump signed his big, beautiful budget bill into law on Friday, July the 4th, Independence Day. US markets were closed, but Bansi Madhavani says it locks in enormous US government borrowing that will keep upwards pressure on bond yields globally. As of 4 a.m. Sydney-Melbourne time, the S&P 500 was closed on Friday, so it was stuck at Thursday's new record high. The 10-year US Treasury yield fell 1 basis point to 4.32%. Gold rose 0.1% to $3,346 an ounce. West Texas Intermediate futures closed on Friday down 0.8% at $66.49 a barrel, although that was before news on Saturday that OPEC Plus agreed to increase production by 548,000 barrels a day in August. Now that's up from increases of 411,000 barrels a day through May, June and July. The US dollar index was flat, and the Aussie dollar begins the week down 0.3% at 65.53 US cents. The Kiwi down 0.1% at 60.63 US cents. Number 2. Speaking of the Aussie and Kiwi dollars, it's a huge week for both the Australian and New Zealand economies, with monetary policy decisions from the Reserve Bank of Australia tomorrow and the Reserve Bank of New Zealand on Wednesday. Up until a few weeks ago, the RBA was expected to hold, while the RBNZ was seen cutting another 25 basis points. But those expectations have reversed over the last week or so. ANZ Research now expects a 25 basis point cut in Australia, but a hold in New Zealand. Here's ANZ Group Chief Economist Richard Getzinger to explain.
If you stand back, you say that's not surprising. The RBNZ's done a lot more than the RBA. But the RBA still has inflation which looks like it's stabilising in the mid to upper part of the target band. So certainly there's no burning platform for the Reserve Bank of Australia to have to go. But the market is pricing it. The activity side of the economy has been a bit softer. People are lined up on the view that they'll cut 25. It would be a very large surprise if they don't.
Number 3. ANZ's head of FX research, Mahjabeen Zaman, says ANZ Research's expectation in the longer term is for the RBNZ to cut 3 more times and for the RBA to cut 2 more, which will help keep the Aussie dollar a bit stronger than the Kiwi in the longer run.
We are expecting the RBA to ease by 50 basis points, RBNZ by 75. And then when we look at yield differentials, RBNZ will likely end up at 2.5. RBA will be at 335. So again, looking at just that on a relative basis, I think Aussie Kiwi will likely be supported on yield differentials.
Number 4. Vietnam did a trade deal with the United States last week that ANZ's head of Asia research, Koon Goh, thinks will set an important precedent. It's a 2-tiered deal that will see Vietnam's exports directly to the United States tariffed at 20%, while any transshipments, especially from China, will be tariffed at 40%.
This is the first time that we've seen this kind of tiered tariff structure. It's quite clear that the US administration are trying to look to clamp down on transshipment or rerouting of Chinese goods through third countries. So this trade deal with Vietnam, which is the first for the Asian region, could potentially be a sort of a template or a benchmark for all the other trade deals that might be done between the US and its Asian trading partners.
Number 5. Koon says Vietnam has been clamping down on those transshipments, so the 40% tariff may not be so painful. And the key comparison for the direct exports should be the difference between a 20% tariff for Vietnam and 10% for everyone else, rather than just paying 20%. And that means the deal may not hurt Vietnam's exports that much.
20% versus 10% is not a significant jump. And given that Vietnam remains a very competitive and efficient producer of manufactured products, I don't think it will take any shine away from Vietnam as a manufacturing and exporting hub for multinationals.
Couldn't go there. Now, in our deep dive interview, ANZ Economist Bansi Madhavani looks more closely at what sort of tariff deals could be done this week and what they might mean for the world's largest economy.
What we are thinking that could pan out on the 9th of July is that a universal or a baseline 10% tariff on all of the trading partners could come into force. At least that is something that we expect President Trump to announce. Some of the higher sectoral tariffs, which are in strategic areas that are important to Trump's own ambition of reindustrializing the economy, be it the steel sector, be it the auto sector, some of those higher sectoral tariffs are likely to continue. But within the reciprocal tariff ambit, it looks like a mixed bag. We are expecting that the deadline for some of the countries who are involved actively in negotiations will be extended, but some countries where the administration feels that the negotiations are not in good faith or not yielding progress fast enough, we think some countries could be subject to reciprocal tariffs going 9th of July.
How important, therefore, is the deal with the European Union?
The deal with European Union is perhaps the most important out of any of the bilateral trade deals that the US is likely to sign. Not only is the EU US's largest trading partner, on the goods account, the US runs massive trade deficit with the EU. So President Trump has been quite vocal in trying to get some sort of agreement done there. Currently, the EU is looking at 25% tariffs on autos, 50% on steel and aluminum, and their baseline tariffs are of 10%. But the reciprocal tariff that President Trump had announced was 20%. And it looks likely that, we will get some negotiation or an interim agreement done with the EU. What could that trade deal look like? Some of the combinations that we think could be possible is there could be a tariff rate quota between the two trading partners, which means that there is a baseline tariff on certain units of exports. Beyond that unit of exports, the tariff rate would increase. There's also possibility of reciprocal tariffs on select sectors like industrial goods, for example, being lowered to zero on a like-for-like basis. But the broader contention between the US and the EU also remain the non-tariff barriers, and this is something that is unlikely to be resolved as early as 9th of July. Now, the US administration has often spoken about concerns on how food standards are different in the EU, how auto safety standards are different, regulations around value-added tax are very different. So these are these non-trade tariff barriers, but we think it's very unlikely that these can get resolved immediately.
And what do we know so far, though, about the inflationary effects of the tariffs?
So far, the data are suggesting that inflation remains quite contained in that sense that disinflation has continued on an underlying basis. If you look at core goods inflation or core services inflation on the PCE metric, inflation pressures are quite contained. But that's not to say that this will continue going into summer months here. We'd look at some of the regional Fed surveys that were done over the last 2 months to just get a sense of how businesses are thinking about passing through the cost pressures. So Atlanta Fed's survey suggested that the firms are quite concerned that the customers are price sensitive, so they are not willing to pass on the entire cost rise to consumers. Anywhere between 47 to 51% of the cost pressures are likely to be passed on, according to the firms surveyed by Atlanta Fed. But in the New York Fed survey, interesting results came through. They're saying nearly 1/3 of manufacturers and nearly 45% of service firms are reporting that they will pass on all tariff-related cost increase, and the period over which that cost increase would be passed on would be anywhere between a month to 3 months. So this is something that the Fed have also been talking about. They're saying that we need few months for the businesses to make their pricing decisions, for it to reflect in consumer prices, and for them to understand what it means for an inflation outlook.
And just finally, it's still some time away before the deadline, but what risks are there for financial markets? What are they most sensitive about?
If we do see reciprocal tariffs coming into effect the way they were announced on 2nd of April, or if the reciprocal tariffs get expanded, these would underscore downside risks to US's growth outlook. And I think on the inflation front, this would then argue for the Fed wanting to wait for more data and being worried about possible inflation impacts as well.
Bansi Madhavani there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, July the 7th. Catch you tomorrow with a closer look at China's use of stablecoins and the idea of China's de-dollarization. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.